The media wants you to focus on the crash to $71, but the smart money, they're looking at the $90 recovery. And here's why. The paper silver game just broke. We are 200 million ounces short this year, and there's only one way to fix a supply crisis: through price. Is $200 a dream? No, it's mathematics. And in the next 15 minutes, I'm going to show you exactly why silver is still on track to hit that target by the end of 2026. What's up, stackers? If you've been holding physical silver through this insane volatility, you've probably asked yourself, did I make a mistake? Should I have sold at 121? Is the bull run over? Today, we're going to answer those questions with data, not emotion, because what just happened wasn't a market collapse. It was a gift, a once-in-a-decade shakeout that just set the stage for the real moonshot. Let's dive in. Let's talk about what the mainstream financial media is calling the February crash. Silver dropped 35% in just days, from $121 down to $71. Brutal, right? But here's what they're not telling you. This is exactly what happens before a vertical move in precious metals. In the hard asset community, we call this the big flush. It's not a bug in the bull market, it's a feature. Let me explain. When silver hit 121 last week, the market was loaded with what we call weak hands. Paper traders, leveraged speculators, people who were in it for a quick flip. These are the people who panic sell at the first sign of trouble, and panic they did. 35% drawdown in 72 hours. But look what happened next. In record time, we're talking less than a week, silver reclaimed $90. That's a V-shaped recovery, and it tells us something critical. The weak hands are gone. They've been shaken out. What's left? Strong hands, physical buyers, industrial giants who need silver to stay in business, the people who aren't selling. Now, if you've studied silver's history, this should sound familiar. Let's go back to the 1970s bull run. Silver didn't just go straight up from $4 to $50. It had multiple pullbacks, 20, 30, even 40% corrections. But each time it recovered and went higher. Why? Because the fundamentals didn't change, the deficit didn't disappear, the industrial demand didn't vanish, the currency debasement continued. The same thing is happening right now. The crash to 71 wasn't a breakdown of the bull thesis, it was validation of it. The market just cleared out everyone who didn't truly believe in the fundamentals. And now we're set up for the real move. Okay, so weak hands are gone. But why does that matter if demand disappears too? Here's the thing, demand can't disappear. And this is the part that most analysts completely miss. Silver isn't like other commodities. You can't just substitute it when the price goes up. In technical terms, industrial demand for silver is inelastic. Let me break that down with real numbers. According to the latest data from the London Bullion Market Association, the LBMA, which tracks global silver flows, inventories are continuing to drain despite the recent price volatility. We're talking about warehouses running low, even at $90 an ounce. Why? Because the industries that need silver have no choice but to buy it. Take artificial intelligence. Every AI server needs silver for its electrical contacts and thermal management. You think NVIDIA is going to shut down production because silver hit $150? Absolutely not. The silver cost in a $50,000 AI server is negligible. They'll pay whatever they have to. Electric vehicles? Same story. The average EV uses between 1 and 2 ounces of silver. If you're buying a $60,000 Tesla, an extra $200 in silver costs doesn't change your decision. Tesla has to buy that silver whether it's $30 an ounce or $300 an ounce. Solar panels? Silver is essential for the photovoltaic cells. As governments worldwide push renewable energy mandates, solar installations are accelerating. China alone is projected to install massive solar capacity in the next 3 years. They need silver, period. Consumer electronics, your smartphone, your laptop, your smartwatch, all require silver for their circuitry. Apple can't just say, well, silver's expensive, so we're skipping the iPhone this year. Not happening. Here's the critical data point. We are currently in the 6th consecutive year of a structural silver deficit. That means we're consuming roughly 200 million ounces more per year than we're mining. Think about that. Every single year, we're drawing down existing stockpiles by 200 million ounces. Those stockpiles aren't infinite. And here's the kicker. Even at these elevated prices, mining production isn't ramping up fast enough to close the gap. Why? Because silver is primarily a byproduct of other mining operations. Copper, zinc, lead. You can't just open a pure silver mine overnight. It takes years of exploration, permitting, and construction. The supply response is slow, but the demand, it's accelerating. So what happens when you have inelastic demand, declining stockpiles, and slow supply response? Economics 101. Price goes vertical. Now let's zoom out and look at the macro picture, because silver doesn't exist in a vacuum. It exists in a world of fiat currencies, central bank policies, and government debt spirals. Over the last 15 years, we've witnessed the largest monetary expansion in human history. The Federal Reserve's balance sheet exploded from under $1 trillion before the 2008 crisis to over $8 trillion at its peak. The European Central Bank, the Bank of Japan, the People's Bank of China, they all did the same thing. Print, print, print. Now, I'm not going to get political here, but the economic reality is simple. When you create trillions of currency units out of thin air, the purchasing power of each unit declines. That's not conspiracy theory. That's monetary economics. Here's where it gets interesting for silver. There's growing discussion in financial circles about a pivot toward what some are calling sound money policies, the idea that central banks need to rein in their balance sheets and restore some level of fiscal discipline. Whether that actually happens or not is debatable, but here's what matters. The market is already positioning for a world where unbacked fiat currencies are less trusted. When trust in paper currency erodes, where does capital flow? Into tangible assets. Gold, silver, real estate, commodities, things you can touch, things that can't be printed. And here's the mathematical reality. If the US dollar undergoes a major repricing, meaning its purchasing power declines significantly relative to real assets, then silver's move to $200 isn't some wild speculation. It's simply a valuation adjustment to reflect the new reality. Think of it this way. Is silver really going up? Or is the dollar going down? The answer is probably both. Silver has industrial value that's increasing, and the dollar has purchasing power that's decreasing. When you combine those two forces, you get explosive price action. There's also a geopolitical angle we can't ignore. Without getting into political predictions, the reality is that we're living in an increasingly multipolar world. Countries are diversifying away from dollar reserves. Central banks, especially in Asia and the Middle East, are buying gold and silver at record rates. Russia, China, India, they're all accumulating precious metals as strategic reserves. Why? Because they've learned the lesson of economic sanctions and frozen assets. Physical gold and silver can't be frozen by a foreign government. They can't be sanctioned, they can't be hacked. They're the ultimate monetary insurance policy. And as more countries follow this playbook, the available supply of investment-grade silver shrinks even further. Remember that 200 million ounce annual deficit we talked about? A big chunk of that is going into sovereign reserves and private vaults, and it's not coming back to market. All right, so we've established why the crash was healthy, why industrial demand is unbreakable, and why the macro backdrop supports much higher prices. Now let's talk about the path forward. How do we actually get to $200? I see 3 key milestones. Milestone 1, $100, the psychological barrier. This is imminent. We're currently at 90, and the technical resistance level is around 95. Once we clear that, the path to triple digits is wide open. I expect this by the end of February. Why? Because the short squeeze that started this rally isn't done yet. There are still futures traders who are underwater on their short positions, and they're going to have to cover. That buying pressure pushes us through 100. Milestone 2, $125, new all-time highs. This is where things get really interesting, and I'm targeting second quarter of this year. What could trigger this? Geopolitical escalation. We're living in a world with multiple flashpoints. Tensions in the Middle East, potential conflicts in the South China Sea, ongoing situations in Eastern Europe. Any major escalation would send investors flooding into safe haven assets. Silver would rocket past its previous high of 121 and establish a new ceiling around 125. Milestone 3, $200, the moon, late 2026. This is the big one, and here's the catalyst I'm watching, a failure of major delivery on the COMEX. Let me explain what that means. The COMEX is the commodity exchange where silver futures are traded. For decades, it's operated on the assumption that most contracts will be settled in cash, not physical metal. Only a small percentage of traders actually demand physical delivery. But what happens if that changes? What happens if industrial users, sovereign buyers, and large institutions all start demanding physical delivery at the same time? The COMEX doesn't have enough physical silver to satisfy full delivery demands. They're running a fractional reserve system, lots of paper claims on a limited amount of physical metal. If there's a run on physical silver, what we call the physical run, the exchange would face a crisis. They'd either have to default on contracts or allow the price to skyrocket to ration the available supply. That scenario, a COMEX delivery failure, would send silver to $200 or beyond in a matter of days. And with inventories already draining and industrial demand surging, that scenario becomes more likely every month we stay in deficit. Now here's the data point that has me most excited, and it's something most silver analysts are sleeping on. The gold to silver ratio, the GSR. Right now the GSR sits around 54 to 1. That means it takes 54 ounces of silver to buy 1 ounce of gold. But here's what history teaches us. During true precious metals manias, this ratio crashes hard. We're talking 15 to 1, 20 to 1, sometimes even lower. Why does this matter? Because it gives us a mathematical framework for where silver is headed. Let's run the numbers. If gold stays around $5,000 per ounce, which is conservative given the current trajectory, and the GSR compresses to 25 to 1, that puts silver at $200 per ounce. It's pure arithmetic. But here's the thing, 25 to 1 is actually a conservative ratio for a full-blown mania. If we see the kind of frenzy that characterized 1980, when the ratio briefly touched 15 to 1 and gold is at 5,000, silver would be over $300. Now, I'm not saying we're definitely going to 300. I'm being conservative with the $200 target. But the GSR compression is already beginning. Just in the last week, we've seen it tighten from 60 to 1 down to 54 to 1. That's significant. It tells us that silver is starting to outperform gold, which is exactly what happens in the final phase of a precious metals bull market. As more investors recognize that silver is both an industrial metal and a monetary metal, giving it dual demand drivers that gold doesn't have, capital will rotate from gold into silver, compressing that ratio even further, and that's your rocket fuel to 200 and beyond. So here's the bottom line. The February crash wasn't the end of the silver bull market. It was the beginning of the final stage. The weak hands are out. The strong hands are accumulating. Industrial demand is inelastic and growing. The supply deficit is widening. The macro backdrop of currency concerns supports much higher precious metals prices. And the gold to silver ratio is compressing right on schedule. Is $200 guaranteed? Nothing in markets is guaranteed. But based on the data, the fundamentals, and the historical precedent, it's not just possible, it's probable. So if you're holding physical silver right now, don't let the volatility shake you out. You've already survived the worst of the flush. The path from here to 200 is going to have bumps, but the trajectory is clear. If this analysis helped you, smash that like button, subscribe for more precious metals coverage, and drop a comment below. Are you holding through to 200, or are you taking profits along the way? Let's discuss.